Mamie, Donald Trump has sent a letter to Canada threatening a new tariff rate of 35% starting August 1st. Donald Trump says he'll impose 30% tariffs on imports from the EU and Mexico starting next month. $2 trillion vaporized in just 48 trading hours as Wall Street's magnificent 7 tech titans folded like tinfoil. Reuters flashes the trigger. A midnight tariff blitz that slaps a 35% surcharge on every Canadian import and threatens a blanket 30% wall against goods from Mexico and the entire European Union, set to hit August 1st. Europe fires back in kind. Ryanair waves a match over its 330-jet, $43 billion Boeing order and dares Washington to blink first. Canada and Mexico. They're already sprinting for the exits, greenlighting a $120 billion Northern Corridor rail and port ghost train that dodges U.S. customs from sea to shining sea. That single steel artery threatens to siphon another $120 billion in premium cargo, on top of the $144.8 billion already skirting American roads every month, gut-punching Midwest assembly lines, Gulf Coast cranes, and Seattle's aerospace payroll in one blow. Stick with us, because over the next minutes we'll map that corridor, crunch the fallout, and ask the one question shaking Capitol Hill. Can strand of cold-rolled steel and a shredded jet deal rock Washington harder than a $2 trillion market wipeout? Let's start by mapping that strip of steel. According to Freight News, the so-called Northern Corridor carries a price tag of roughly $120 billion. It strings Prince Rupert's Pacific megaport to a brand-new Gulf terminal outside Tampico, bolted together by the freshly merged CPKC rail spine and a blockchain customs system that clears a container in minutes. Planners are blunt about the stakes. They say the corridor could peel off up to 50% of the Canada-Mexico freight that today rolls through U.S. highways and harbors. Bureau of Transportation Statistics. Data put that pool at a record $144.8 billion in March alone, the highest single-month total ever recorded. Do a little back-of-the-napkin math. If even half of that cargo shifts north and south without touching a U.S. checkpoint, Washington's customs ledger would leak more than $70 billion a month. That's enough to eclipse the entire yearly GDP of Alaska before Thanksgiving. The political fuse is already hissing. On July 16th, Reuters chronicled a call between Mexico's President Claudia Sheinbaum and Canada's Prime Minister Mark Carney. The two leaders pledged to fast-track a bilateral trade accord in light of President Trump's August tariff deadlines, and hinted that a signing ceremony could land before New Year's Eve. Every kilometre of rail welded now locks in a future supply chain habit. Insurers rewrite risk tables. Bond desks shave revenue forecasts for Long Beach. And Detroit suppliers wonder how to chase a breaker that suddenly rides a tariff-free rail to Veracruz. So this isn't a blueprint on a lobby easel anymore. It's concrete pouring in Prince Rupert and rebar bending into Matamoros. Each slab, another dent in America's tariff shield. Because once wheels turn, trade war math becomes real money. The countdown is on. Think the Northern Corridor is still a bluff? Tell us in the comments before the first freight train does the talking. Now, Washington turns the pressure dial past red. On July 10th, President Trump signed an order slapping a flat 35% tariff on every Canadian product that crosses the border, effective August 1st. Less than 48 hours later, Saturday, July 12th, he threatened an across-the-board 30% levy on goods from Mexico if talks collapse. The twin deadlines land at dawn on August 1st, leaving two of America's biggest suppliers just weeks to either bend or break. The paperwork is brutally specific. It lists steel slab, rolled coil, engine blocks, and transmissions as facing the full charge. Separate sectoral duties, 50% on raw metal and 25% on finished autos, remain in force. Ottawa calls the move economic blackmail. Mexico City brands it colonial déjà vu. Markets seem half convinced the White House will blink again. Yet the currency tape tells another story. Within hours of the Canadian announcement, the loonie dipped 0.25%. Its worst daily slide in a month, as traders dumped exposure to northern exporters. By the following Monday, the Mexican peso had weakened nearly 0.5%, signalling investors are bracing for higher import bills, even while diplomats still talk tough.